Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 180. Well, 2026 has started with a bang. There has been no rest. So we have so many things to talk about. We have Venezuela, we have earnings, we have Greenland, we have credit card interest rates, we have big tech, we have Taiwan Semiconductor. So let's get started. As always, get your mind right and let's get to work. Well, welcome back to the podcast, everybody. Welcome to 2026. We're already halfway through January. So the year starts fast, doesn't it? We end with a, busy end of the year, and we're thinking about like, okay, I'm just going to rest a little bit maybe, but the stock market just doesn't work like that. It just keeps going. So right from the beginning, we start having things that we're dealing with. So, you start the new year, we look, S&P's up about 1.3%. We have the NASDAQ up about 1%. Dow Jones actually with the early lead at 2% for the year. But if you look at the Magnificent Seven, it has not been a good start for the year for them. So you look at NVIDIA is basically even. Google's doing okay, but Microsoft, Apple are down. Tesla's down at the start of the year. So we'll see how we kind of end up here. But there does seem to be like some broadening out of the market, which we will talk about here in a little bit. But you look and you see, so we start the year, we have Venezuela happen. We have Trump and the U.S. troops going in there and removing the leader of Venezuela. And so all of a sudden you see all the oil stocks start to spike up. And, the theme of this week's episode basically is going to be, you have to be very careful that you don't change lanes too quickly and you don't change your investment strategy too quickly just based on the headlines. Because just as quickly as they can change, they can go back. And sometimes, I think we recorded an episode maybe years ago called Switching Lanes, where it's like being at the grocery store, right? All of a sudden you see the lane next to you start to go a little bit. You move over, the lane that you were in, starts to move. And so all of a sudden you just kind of miss these moves. And so you have to be very careful that you don't change your strategy, too often, or you're chasing kind of the flashy thing here. And so you just have to be very cautious of that and make sure that you're making, these decisions because you think something is fundamentally going to change and not just change for the next couple of weeks. So when you look at Venezuela, there's a lot of fanfare about jumping into oil companies and all that. There was a meeting at the White House and there were some companies going, man, it's just not like something we want to do. It's not something we want to invest in right now. And so you see ExxonMobil being one of those that discusses this, and the White House wasn't happy about their reaction, but Chevron is the only major oil company still in Venezuela. There's a lot of infrastructure needs, and so you would look and if you think that that's going to be something that's viable, it's going to be a while before some of the major oil companies were to get in there. More likely than not, it would be the Halliburtons and Baker Hughes and Schlumberger's and those kind of oil field type service companies that would have to go in there and build up that infrastructure. So even if it turns into a viable option, it's going to be a while. Valero would be a company that could potentially benefit as well because they could refine that crude on basically the Texas Gulf. So, but it's still one of those things where it's not going to be something that you see right away. And so initially you get this move up from the oil companies initially, and then a day or two, it kind of subsides. And so you have to be careful of that in your own portfolio, that you're not just basically trading on headlines that eventually that trade just kind of falls away because the money's got to come from somewhere. So the next time the news changes, people sell the oil companies and now they're moving on to something else. And so just be careful with that. We saw that, I guess we would call it being whipsawed, but you saw that too. So a couple weeks later, or basically a week later, Trump announced that he didn't want defense companies to pay dividends or do share buybacks. And so when he announced this during kind of the middle of the day, all the defense stocks sold off. Northrop Grumman, whose symbol is NOC, Lockheed Martin, symbol LMT, all the big defense companies, they start selling off. Well, then after hours, Trump again announces that he wants the defense budget to go to $1.5 trillion, which is a 50% increase. And then all of those same companies that just traded down hours before popped heavily on those comments. And so then everybody rushed back into those trades. And so again, just a kind of having a level head and balanced and not moving too much off of that. Another one would be, there's a lot of political stuff here at the beginning of the year, right? Side note, I had a professor in college that used to tell us that when it came to investing, there was a lot of things that you could account for, but political risk was one of the ones that was the hardest because it could change so fast and it was very tough to model. And of course, at the time that I took that class, there really wasn't a lot of political stuff going on. And who would have thought that would have become such an important thing to remember 20 years later? So the other one would be banks, credit card companies. Trump wants credit card companies to cap interest at 10%. And so you saw Capital One fall on that news. You saw American Express fall on that news. And so, again, is that going to happen? We don't know. I mean, the thing is you can say these things, but when you start really looking at the ramifications of them, it gets messy in a hurry. So the reason that credit card interest rates are higher than other types of loans is because credit cards don't have any kind of collateral, meaning that if you don't pay the credit card company back, they really can't come take that vacation back from you. They can't come take that meal that you just ate back from you. And so there's no collateral. There's nothing for them to come get. Whereas if you don't make your car payment, don't make your house payment, they will eventually come take that back from you. And so, Trump is trying to spur the economy. He thinks that I don't know what he's thinking, but I'm just making an assumption here, which is probably the wrong one. But that if we lower credit card interest rate down to 10%, that more people will go out and spend money. So one of the things you have to remember is that the U.S. GDP, so the gross domestic product of the United States, 70% of that number is made up from consumer spending. So this is people going out, spending money. That's where so much of the American economy comes from. So, unfortunately, financial podcasts are never going to be that popular because we need people to spend money. The United States needs people to spend money. If we were a country of savers, the economy would not do well. So I'm guessing the assumption is that people will go out, they'll spend money, they'll buy things, which will be good for the economy, good for businesses. The problem is that if you were to do that, all of a sudden, Capital One, American Express, a lot of the credit card companies, their business would fundamentally change and they wouldn't be able to offset, the bad credit cards where people can't pay them back, all of those things. And so what they would probably do is they would not allow people who really need credit cards. Maybe they have low credit scores. Maybe it's the only access to credit they have. They would end up cutting that off to them because they wouldn't be able to price it properly and it wouldn't be worth the risk to make them that loan. And then all of a sudden, you actually wouldn't get an increase in spending because there's so many Americans who have low credit ratings that would not have a credit card anymore and wouldn't be able to spend any money. So there's these things that happen. They're big headlines in the news, but there's certain things that have to happen. If they were to, basically lower credit card or cap credit card interest at 10%, Congress would have to approve that. There's all these things that would have to happen. A lot of the major banks have already come out and talked about all the problems that this would cause. And so maybe it's a, negotiating starting point on some other thing that they could do to help people out. But when you really start carrying some of these ideas through, it is a lot more complicated and a lot more nuanced than maybe you originally thought. So same thing could be said for Venezuela. Same thing could be said for some of the defense contractors, all of that. So when you look kind of at the market, at the end of the last year, one of the big concerns was AI. Is it a bubble? Is it not a bubble? Have we started investing way too much into AI before we see kind of the results of that? Well, this week the market wasn't doing that well, and this is January 17th that I'm recording this, and so the market wasn't doing well. And then we had Taiwan Semiconductor report their earnings, and they had a fantastic report showing that the demand for AI is absolutely not losing any kind of steam. And so midweek, you saw kind of the AI trade come back because that report was so good. So NVIDIA kind of woke up, AMD woke up, ASML, which we've talked about, Lam Research, Micron, which is the memory chip maker. So all of those companies and stocks started really coming back strong because that Taiwan Semiconductor quarter was so good and their outlook for the year was really good. So as we move into earnings season, we had banks report this past week. The banks had good, their revenue growth was up. They had good earnings reports. They had moved up into earnings, meaning that the stocks had done really well right before they reported their earnings. And so there was some pullback on those companies because of that. I don't think that'll be a long-term negative for them. I just think that sometimes when a stock goes, moves up way into the quarter, it's really hard for them to kind of keep that momentum. And so this next week, we'll start to get some tech earnings. So we'll have Netflix reports this week, Tesla reports this week. Netflix is the stock is not done well over the last 3 months. It's actually, I don't know, I think I like this price depending on what's going on. But I think it was $130 a share. It's now around $88, $89 because of the Warner Brother Discovery news. And if you haven't heard that, Netflix is trying to buy Warner Brothers Discovery. And so that would bring a lot of assets, characters and storylines and all of that. Paramount is also trying to buy Warner Brothers. And so for now, it looks like Netflix's stock is going to be kind of stuck until we figure out what happens here. So if Paramount were to get Warner Brothers, or if Netflix were to get it, there's shareholders have to vote. There's all these things that have to happen, and that's not going to probably come around except for maybe 6 to 9 months from now. And so it's kind of this wait and see thing. And so there's a lot of maybe investors that are like, okay, well, I'll figure out what happens with that and then I'll return and invest. And so it's really been stuck at around $90 for the last month or so, just kind of on the news of what's going to happen with that. But we will start to get technology companies reporting. A lot of the other S&P 500 companies will reporting. Their guidance on what they see happening in 2026 will be key. Are they seeing any fault in the economy? One of the things I've mentioned on this podcast many times before is to pay attention to the unemployment number. We had unemployment come out in December. It wasn't a bad number, and unemployment actually went from 4.6% to 4.4%. And so that was a good sign. But I do think that, you've had the Magnificent Seven, you've had these technology companies. They have carried the weight of the market for, 18 months. And you're starting to see that broaden outside of them. And so some of the companies that are, software companies, they have not done well. That's the Salesforce, ServiceNow. Those have not done well. And you're seeing kind of this, if we look at data centers and you look at what it takes to build a data center and just kind of the amount of infrastructure that you have to go into these, you're seeing companies like Cummins do well. Caterpillar has done well. I think those are, looking to probably expected to have a pretty good year. It's not only Caterpillar. Everybody thinks about the earth movers, but it's also the turbines and the things that they make that aren't just the machines that move dirt. Cummins with their engines and powering some of those big, heavy construction vehicles and those kind of things. There's also a company called L3Harris. I don't know if I've ever mentioned this. Another defense contractor looked to have gotten a big contract from the federal government up to $1 billion. And they're actually going to spin off another part of their company this year into another public company. So I like looking at those, but it's also like, it's kind of nice to get to kind of move away from some of these technology companies who are still good, but just kind of stuck. If you look at Microsoft, I mean, that stock has not done anything for the past 3 months. It's just slowly starting to trade down. I think that's because of Microsoft's investment in OpenAI, which has received just tremendous competition from Google, which is parent company Alphabet, but still trades under the symbol GOOG and GOOGL. But the Gemini product from Google looks to be much more competitive for OpenAI than they first expected. There was an announcement that OpenAI is going to start to run ads for their free product, which, boy, that seems pretty quick for that to start happening. So looking to monetize that, looking to generate some income. And so we'll see. But again, when you think about like just all the political stuff going on, before I started recording this, I think there was more news on Trump trying to take over Greenland and the political risk with that, with NATO members. I mean, there's so much political risk out there. And that's one of the, it doesn't seem like it matters in the market until it does. I mean, it's kind of like last April we had Liberation Day and the market did not like that. And that market sold off very quickly and very hard. And so it's almost like you're always looking around every turn, wondering, what's going to be the one thing that finally is the, proverbial straw that broke the camel's back, if you will. The market doesn't care until it does. And so it's always like, man, you pushing it to the limit, where is that limit going to be? So you have to be very careful. You have to make sure that the investments that you're making, the way that you set your portfolio up, these are companies that you really do want to own. If the market were to kind of go against this, you want to be sure that you're in companies that you would be okay holding for a while. And so these are companies that pay a dividend, possibly things like that. So the money is actually, that you're earning an income while you wait. But overall, the economy looks to be in a pretty good spot. I mean, we look to be in a pretty good spot. I mean, obviously we have inflation and I completely forgot to add on my list that Trump was going to sue Jerome Powell. And that really got world markets kind of up in arms. And you had other Fed chairs from around the world writing in, giving their support. So there is a lot of stuff going on, and it is only January 17th. So it is kind of wild when you look at just the number of storylines that we're dealing with, and you still have the market, up a little bit. I mean, for January, it's pretty good. I mean, already being up 1%. So, but it does seem like it's kind of a minefield out there. But again, the market sometimes can just climb the wall of worry is basically what we call that, where, even though there's all this other thing, all this noise going on and, the political noise and just the outside noise, companies are still doing great things. They're still trying to make money. Their revenue's growing, their profits are growing. And so as an investor, you sometimes have to look past all of that, but you do have to be aware and cognizant that it can change. And so that's why it's so important, as we preach all the time, of really being committed to the companies that you're investing in, knowing who they are, what they do, how they make money, and, basically saying, I'm an investor and I'm going to invest in this company for years to come. So I hope that was beneficial for you. Our first episode of 2026. And as always, don't mistake activity for achievement, and I'll see you next time. Thanks, everybody. This podcast contains general information that may not be suitable for everyone. The information contained here should not be construed as personalized investment advice. There is no guarantee that the views and opinions expressed in this podcast will come to pass. Investing in the stock market involves gains and losses and may not be suitable for all investors. Information presented here is subject to change without notice and should not be considered as a solicitation to buy or sell any security. Rydar Equities does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstances. Past performance is no guarantee of future results.